Welcome to the Trading Bootcamp Part 5. This series is a trading course designed to give you all the tools you need to get stuck into the markets and become a profitable trader. In this lesson, we're going to be looking at liquidity. Okay, what is it? And more importantly, how can we use it for our trading? So let's get stuck in. All right, first, let's look at what liquidity is. Okay, in its simplest term, all right, liquidity is unfilled orders in the market. Okay, liquidity is unfilled orders in the market. Now, these can come in different forms and we'll get stuck into that, but it's really important to understand that liquidity is unfilled orders. All right, now, liquidity is the fuel the market needs to move. Okay, we've already looked in previous lessons and understood that every order must be paired. Okay, meaning that every buy order must be matched with a sell order, okay, and every sell order must be matched with a buy order, okay, meaning if there's lots of buy orders, it has to find a lot of sell orders to match and pair those orders, and if there's a lot of sell orders in the market, it has to find an equal amount of buy orders to match. And that is essentially what moves the price. Okay, the price and the market is constantly in a state of flux. It's a two-way dynamic auction that's continually moving, trying to pair orders. Okay, if we know that liquidity is the fuel that the market needs to move, right, we know that liquidity is a magnet for price. Okay, the market is going to seek out liquidity or areas of high liquidity because it needs to match these buy orders with sell orders and these sell orders with buy orders. So when we think about liquidity, there's two main types. Okay, there's going to be resting liquidity. Okay, this is essentially your limit orders. Okay, orders that are resting in the order book above and below price. Okay, this is current price. So it would be the resting liquidity above and below current price. Okay, and also we have engineered liquidity, okay, meaning that if price moves to a certain point in the market, it's going to trigger orders. Okay, essentially trigger traders to enter market orders at certain points. Engineered liquidity and resting liquidity. Okay, two important concepts to understand, that liquidity can either be resting already in the market or be engineered when price gets to a certain point. So now let's have a look at where we can expect to find high levels of liquidity in the market. So here we're going to look at some locations where we can expect high levels of liquidity, also known as liquidity pools in the market. Okay, now essentially these orders are going to be majority made up of stop loss orders and breakout traders. Okay, so orders that are triggered when price gets to a certain point. So the three most common locations that we will find liquidity is swing points, equal highs and lows, and trend line compression. So let's break it down and go through these one by one and look at why there is liquidity at those points and how it is important for us. Okay, so first one is swing points, right? Key swing points in the market. The more prominent a swing point is in the market, the more liquidity that's likely to be there. Okay, and the reason for this is clearly at this point in the market, price rose to a level and then there was a lot of selling in the market this level here to push price down. Okay, meaning that a lot of sell orders were executed here. Okay, now majority of traders that have sold here would have their stop loss traditionally above this point. Okay, so if we look at that with our long short tool, okay, let's just say a trader has got short in at this location. We'll make this a bit more intense so we can see it. Right, so if traders are short him at this location, they've sold here trying to target price down, their stop loss order will be a buy order. Okay, if you've shorted the market, you've sold, your stop loss or your exit will be a buy order. Okay, meaning that there's going to be a lot of buy orders resting here in the form of most likely stop loss orders. Okay, so at key swing points, whether it's a swing high like this or a swing low, is going to have a lot of orders resting underneath it. It's essentially stop loss orders, which is the opposing order to what was taken here. So we can see key swing points in the market, these become a strong liquidity pool in the market and price may revisit them to fill orders, right? Secondly, we have equal highs and lows. Now this is basically the same principle, okay, except we've just basically got double. Okay, so it's like a key swing point, but we've had double, all right? So traders that have entered here and clearly price is pushed up, so we know there's a lot of buying at this level, their exit for this position will be a sell down here. And same again, okay, maybe traders are defending their position, a lot of buying going on here. That means stop loss orders down here, okay? So if we look at it like this, with a long short tool to help us understand what that positioning would look like, right? We make it a little bit darker. We can see that those traders that order there, likely in this region, resting underneath this stop loss, is going to be sell orders. Okay, buy orders here, their stop loss will be a sell order, meaning that this location under equal highs and lows becomes a big liquidity pool, right? And the last one we can look at here is trend line compression liquidity, right? So this is essentially a combination of multiple swing points. Okay, when we see price move like this, we have the grinding move higher. Okay, each one of these lows is going to have liquidity resting underneath it, mostly in the form of stop loss orders. And in a grinding price move like this, none of these lows get swept, okay, meaning that price doesn't come back down and move higher, clearing out some liquidity. So essentially it's just building, it's compression, okay? So it's a grinding price up where none of these lows are sweeping the previous low, meaning that we've just got untapped liquidity resting underneath all of these little sort of mini swing points all the way up. And the same can be said on the way down. You have grinding price action down. This is going to be building liquidity because everyone who's shorting through this region is going to have stop loss places all at different spots. So sometimes when we can break structure, this can be a really quick impulsive move to clear out this liquidity. When you see grinding compression, and we'll get into the chart soon and look at this, price, once it reverses, breaks market structure, it can move quite quickly through the grinding areas because there's a lot of fuel. Essentially all the way through here, there's buy orders, okay, stop loss orders, which keep rocketing the price higher and higher, okay? So that is the key locations we can find liquidity on the chart. Now, very important concept. How can we use liquidity? Okay, it's really cool to know where it is, what it is, but how can we use it in our trading? All right, so we'll look at the three main reasons. All right, number one, confidence to trade once liquidity is swept. Okay, so we're looking to level in the market, we're wanting to buy at this level. If we see price come into this level and sweeps a load of liquidity, we can see that there's very likely enough fuel gathered in the market. It stopped out a lot of traders, it's got all the fuel it's needed, it triggered a lot of sell orders below a level, okay, meaning that people want to buy here have got in. Okay, so maybe there's a lot of buy limit orders down here and they need to be filled with sell orders. So it pushes price to a level where stop losses are triggered, okay, triggering lots of sell orders, meaning all these buy orders get filled and can move in this direction. So it's very, very, I guess, probable and strong when you have a strong liquidity sweep at your trade location. So confidence to trade with it once liquidity is swept in your direction. Okay, you see a lot of traders stopped out, orders being filled, traders getting liquidated. And when a large amount of traders get liquidated, that's often a really good time to get in the market and trade in the other direction. Okay, second reason, target liquidity with our trades. Okay, so potentially we see some, equal highs in the market and we know that this is going to be a point for resting liquidity. Maybe we see a perfect entry trigger down here and we want to get into a trade, and this can be our target. Okay, we're looking for this equal high liquidity to get taken out in the market, and we'll look at this more in the charts in a second. And the next one is to keep us out of trades if liquidity is resting behind. Okay, maybe there's a bottom in the market, looks a bit like this, double bottom, and then we have a nice sort of zone here that we're looking to trade from, right? Price revisits it. Maybe it can keep us out of trading here because we see this equal low resting liquidity behind, and we can assume that price is very likely to take this out. So this might stop us from entering, a long trade in here somewhere because price has the tendency to search out that equal low liquidity before moving higher. Okay, so it's very important to not take trades when there's really obvious liquidity pools essentially resting behind your trade. So let's jump in the charts. We'll look at all of these concepts. We'll look at how to identify and how we can build some trade ideas using liquidity. All right, so we'll start on a chart here of Bitcoin. And Bitcoin in this example has been in quite a ranging environment, okay, meaning that this is sort of range high, range low. Okay, so this is sort of shorting opportunities at the high probability long in opportunities at the low. And this is sort of seen as a big area of fair value in the market, very, very rotational. So liquidity sweeps become very powerful in this ranging type of environment when we look for deviations at the extreme of this range. Okay, so I'm just going to go ahead and mark out some key liquidity and see how price reacted once we swept it. Okay, so down here at range low, we could see that we had a lot of liquidity building. Okay, we had 3 swing points, 1, 2, 3. Okay, they're very deep swing points, which tell us there's likely to be a lot of liquidity here, and none of them got swept. Okay, this point didn't sweep this point, and this point didn't sweep the previous. So we've basically got triple lows, which also lines up with our range low here. Okay, so a lot of liquidity down here, and we can see what happens when price had an aggressive stab down, right? And we'll just mark it out so you can see it. Aggressive stab down, and we'll zoom in a little bit on this. Price swept, triple bottoms, equal lows, stopping out a lot of traders. There would have been a lot of sell stop loss orders triggered down here, allowing a lot of big players to fill their buy order, okay? And price reversed very, very strongly in the opposite direction, okay? Big liquidity sweep at range low. Price stopped out a lot of traders. It would have been breakout traders shorting down here, filling big smart money buy orders, which pushed price in this direction, okay? So that's the first one. Next one, we had another very aggressive stab down here. And quite often, the more aggressive price is into a liquidity level or into a point that we expect liquidity to be resting, the more aggressive the sweep is going to be and the reaction. Okay, so aggressive selling shouldn't be a scary thing. Okay, inefficient price action is likely to get revisited and returned. Okay, so now we can see down here even further at range low, we've got this swing point here and this swing point here. So we've got 2 points. Price moved down very, very sharply, swept it, got back inside and took off. So swept this low and also swept this low. 2 big sweeps of liquidity. And obviously we need to use this in conjunction with our context and location. So we're looking at range low and an SR level flip, and we'll look at support and resistance later in this course. Big sweep of liquidity, lots of traders stopped out, lots of orders triggered down here and filling those big buy orders. Price moved in the opposite direction. Okay, so we can start to see this happening all over the chart. And we saw it again here at the highs of the range. Okay, big key, deep swing point. A lot of traders would have shorted in here, meaning buy stops up here. And given that this was all-time high, there would have also been a lot of breakout traders wanting to buy this if price came into this level. You see what happened? Price came into this level and swept it. Okay, pushed into it, failed to close above, and had a very strong reaction back down. Okay, so we see this happen all over the chart. Now let's have a look at another chart. Okay, now we're looking at Ethereum and we're going to see the same principles and concepts play out. Okay, so the really, really obvious big bottoming liquidity sweep we saw recently here. Okay, so we had down here, this is equal lows. It's probably 4 or 5 equal lows down here. It's almost a bit of compression too, but nothing got swept here. Okay, lots of resting liquidity down at this level before a very, very big move up in price. Okay, then price pushed down again, did not sweep this level, so created more liquidity resting under here. Okay, so we had a lot of liquidity building down at the lows. Then we saw a big selling event in the market, and like I said, the more aggressive and impulsive this stab into a level is, the more likely it is to reverse. Okay, if we see what we need to see down here. Okay, so all of these lows got swept, so we can mark that with a horizontal liquidity sweep. We can see this here. Price swept, took off, broke structure in the other direction, and that's just sign of reversal in the market. Okay, so we see these all over the charts. Now we'll drop to a lower time frame. I want to show you some compression liquidity. Okay, all right, so now we're looking on a lower time frame, and I want to take your attention to this bit of price action here. So this is that grinding price action we talked about in the example that gives us this trend line compression liquidity. Okay, meaning that on this push down in price, none of these highs got swept on the way down. Okay, it's just lower highs, very grindy price action, not big swings in price. Grinding means a lot of shorts are entering down here, a lot of sell orders, and they're gonna have their stop losses above here, which is buy orders. Okay, and we can see what happened. Price came into a level, also had equal low liquidity under here. It swept it through this region, right? We can see price pushed down, swept the liquidity, then it broke structure to the upside and very impulsively moved to take out all of this. Okay, there's a lot of fuel through here because of all of these buy orders through here, which would have been stop loss orders due to all of the shorting getting in the market. Okay, so we've looked at swing points, we've looked at equal highs and lows, and now we've looked at compression liquidity. So I really suggest you get into the market and start marking these out on your charts. Okay, so looking for areas where there's likely to be liquidity resting. Okay, so we want to be looking for key swing points. We want to be looking for equal highs and lows. Okay, and it doesn't just have to be 2 as in equals. Okay, you can have 3 triple, quadruple highs and lows, and your compression trend line liquidity. So this is one of the main things you need to be marking on your charts. Okay, and that's spelled incorrectly. Liquidity, much better. All right. So when you mark these on your chart, you can use them for your trading. Okay, you can use them to trade with confidence once they're swept. You can use them to target them with your trades, and you can use it to keep you out of trades if liquidity is resting behind. Okay, here's sort of a decent decent example of when we wouldn't trade when there's liquidity behind. Okay, you know, this might look like a decent demand zone. Prices moving in, we expect to bounce, but we look down here and we can just see all of this liquidity resting underneath price that's just waiting to be taken. Okay, we can see it right here. It's very grindy. There are multiple swing points that haven't been swept. This is just typical equal low / compression liquidity on a bit of an angle. So price is very likely to come in and take out this level, which it did. So context and location is key, but jump in the chart, start marking out your key swing points, your equal highs and lows, and your compression trend line liquidity. And later in these series, we're going to combine this liquidity concept with everything else we're learning and look at how we use it in our trading to find the highest probability trades. So we'll see you in the next one. As always, any questions, drop them in the comment section below.